the Securities and Exchange Board of India has come out with an elaborate consultation paper on the expense ratios of mutual funds. As the fund industry grows in size, the regulator wants fund houses to share the economies of scale and pass on cost benefits to customers. It has also come out with proposals on curbing malpractices by distributors, such as churning investors from lower cost funds to higher cost funds. To understand the nuances of this consultation paper, we spoke to Vidya Bala, co-founder, Primeinvestor. Do watch this interview to learn the details. Good afternoon, ma'am, and welcome to our show.
Good afternoon, Sanjay. Thank you for having me in your show.
So Sebi has come out with a very elaborate paper, consultation paper on the total expense ratios of mutual funds. So we thought this was a very good occasion to speak to an expert like you and try to understand on behalf of our viewers, why is Sebi proposing to make these changes? What is the background and what does it hope to achieve? My first question to you is, could you give us an overview of the 3 or 4 main changes that Sebi is proposing?
Right. So yeah, Sebi, this is not the first time that Sebi has come up with consultation papers to change operational issues or business related issues or fund related issues in mutual funds. But this time around, Sebi's focus appears to be on rationalizing or rather reducing the costs for investors. That appears to be the broad theme, and it has tried to look at this from various angles. So one is that SEBI is trying to look at what are the expenses that a mutual fund incurs over and above the total expense ratio, and how those could become inclusive, brought into TAR, or even cut down. The second thing that it has looked at is what is called as performance-based TER. In other words, funds charge investors based on the performance of the fund. A fund that performs better will be able to charge a little more than a fund that is underperforming the benchmark. So that's the second thing. The third thing is to reduce or cut down on some of the undesirable practices in the industry. There are a number of things that Sebi has mentioned, which we'll probably discuss by and by. One of them, for example, is the cost that investors undergo simply because they are asked to switch funds. And typically, this is from a lower cost fund to a higher cost fund. And that means paying a more expense ratio and churning their portfolio for the sake of, just moving a fund. So that's another thing where they have, been firm in the consultation paper about such practices. There are more such practices. So broadly, this is how I would put it. Rationalization of costs, linking expense to performance rather than just a flat, fee, and curbing some of the less desirable practices that either result in higher cost or more churning for the investor.
So, as you said, SEBI is keen that mutual fund houses should share the economies of scale with their customers. Could you explain for our viewers what is the background against which it wants this to happen?
Right. So, SEBI has been probably looking at the growth of AMCs, not because it doesn't want them to be profitable, but it is trying to see if with growth, with scale, with larger AUM, whether funds are able to pass on the benefits to customers in terms of lower expense ratio. If you see even the current slab of expense ratio linked to AUM, you will see as the AUM grows larger, the expense ratio that a fund is allowed to charge comes down. But in spite of this, SEBI feels that expenses, the economies are not passed sufficiently to investors. How did it find this out? It looked at the various schemes and the maximum that is allowed to be charged under different categories. It found that largely with debt schemes, the expense ratio is much lower than the maximum allowed by SEBI. Whereas in equity and hybrid schemes, the expense ratio is very close to the cap that SEBI has. What does this really show? right? So with debt products, they are largely institutional driven. The investments, the inflows come from institutions. And when that basically comes from institutions, they have a better bargaining power. And SEBI thinks that therefore, those with higher bargaining power have got a good deal, whereas equity and hybrid, which are largely held by retail, where the bargaining power of a retail investor is so quite low, there the investors have probably been charged to the hilt. So this is one observation that SEBI made, that retail investors are not really getting a good deal like institutional investors. The second thing is that SEBI looked into the profitability. Are AMCs in a position to really pass on their benefits to investors, customers? So it classified AMCs as large, medium, and small AMCs. Large typically is those that have more than 5% each of the industry AUM share. And medium AMCs anywhere between 1 to 5%, and small AMCs less than 1%. It found that 8 AMCs are these large AMCs that control almost a chunk or 3/4 of the total AUM of the industry. And these are all highly profitable with PBT, profit before tax margin, as high as 70%. And even these medium AMCs, it found there are about 10 of them, 8 in large, 10 in about. All 10 have become profitable, especially in the last couple of years. The few that were not profitable have turned profitable, and their profit before tax margin is about 50%, right? With small AMCs, there are still a few that are not yet profitable, and in any case, they account for a very small chunk of the overall AUM. So this observation, basically SEBI did not point at their profitability. SEBI is trying to say AMCs are making sufficient money, and it is possible to pass the benefits to customers, and yet a majority of equity schemes and hybrid schemes are closer to the cap that SEBI has given. And this is where it says cost rationalization becomes important. And that is the main thesis behind this consultation paper and what SEBI has tried to do through this consultation paper.
And now it proposes to link the TER to the AUM of specific funds instead of the AUM of the AMC, is it?
No, so it's going to link it to the AUM of a category within an AMC. Right now, it's category wise alone, right? So you will have certain categories of funds that are you can charge so much, etc. Now it's going to make it broader. Equity and equity-oriented schemes together, add up all their AUM, and if your AUM is X, and for this X AUM, this will be the graded slab in which you will fall, right? So what is it trying to do through this? Let's understand the reason behind this. Earlier, what used to happen was there used to be a large scheme. Naturally, a large scheme, because the expense ratio was on a per scheme basis, large schemes would have lower expense ratio, and there would be in the same AMC another equity scheme with lower AUM, which would be charging a higher expense ratio. And oftentimes, the practice was that inflows were being diverted to these schemes with lower AUMs, so that the expense ratio can be charged higher. Now that practice is no longer possible because this scheme A equity and scheme B equity will all fall under the common cap. If scheme B equity is having a higher AUM and scheme A has a lower AUM, I will all the funds together have to be put, the total. So supposing this is 20,000 crore and this is say 5,000 crore, and my overall slab will be as if it is for 25,000 crore. So the first 2,500 X, the next 2,500, whatever SEBI has prescribed, will be for 25,000 crore and not separately for 5,000 crore and 20,000 crore. So what happens essentially is a scheme with lower AUM cannot charge higher. And therefore, all these diversion tactics of moving inflows towards a lower AUM fund, all of that cannot happen under this proposal.
And it has also suggested consolidating the total expense ratio figure. Like earlier, you had a base TER, and fund houses could levy many charges over and above this. Now it is proposing one single figure. Now, why does it want to bring about this change, and what will it mean for investors?
Right. So there is this base TER, and many investors were not aware that AMCs are allowed to make certain charges above this base TER. Those were on account of four heads. One is the brokerage and transaction costs incurred for execution of trades. The other is expenses of up to 0.3% of your daily net assets towards inflows from B30 cities. The third is an additional expense capped at about 0.05% of your daily assets for schemes with provision for exit load. The fourth one was GST on your investment and advisory fee, which is nothing but the management fee. So these four were in addition, and SEBI actually observed many undesirable practices happening under these heads. SEBI has made extensive comment about the kind of wrong practices of charging additional, expense ratio for B30 cities, not entirely following the rule to a T. The other thing was funds were using smaller brokerages than the large empaneled ones to execute trades at a higher cost than the larger ones. As a result, these were adding up much more to the overall cost of the fund. So SEBI has therefore now, come out saying these are things like, GST on investment advice. All of these were given as some leeway. Now all of these can be brought into the total TER itself, because I'm going to increase. The SEBI has, suggested increasing the cap slightly to accommodate all of these, and it has also given some more flexibility. For example, AMC can be its own broker to just buy, scripts in for its own schemes. So that way, it can still optimize on cost. So it has given some leeway in the overall TER to accommodate all these costs. What happens is that in some ways these costs get cut. And more importantly, there is transparency. That is, an investor knows exactly these are the costs. Everything is all inclusive. I mean, so the cost is all inclusive. So I actually know what exactly the charges are on my fund. So that's what a SEBI has tried to do here.
So I want one clarification here. What happens currently when I see the expense ratio of a fund, say on its website? Is that all that I am charged? Does it include all these other charges, 3 or 4 categories? Or
the total expense ratio you see, yes, it is inclusive of all of these. Right? So there's nothing separate. So the actual NAV that you get, is after all of the deductions. So the returns that you get is the actual returns. And the total expense ratio, that is why you will see in some funds, the total expense ratio was even as high as 2.7 or so, which was never allowed in the first place, right? So, what often, you see in the breakup that the MC would give is something called base TER. And that base TER is what SEBI was allowing. And it allowed leeway in these four without specific caps in some of them, and that is where they were quite flexible. Like brokerage and transaction, there wasn't a cap. GST by its very nature, it is capped. I mean, it can only go up to so much. But this B30 practices, so all of these brought a level of uncertainty in terms of whether my expense ratio is really what it is, because it can keep changing also every time. So there was a lot of uncertainty. By bringing this in, now it's capped, there is a lot more certainty. So this is the max that you can go to.
There is also a proposal to link the expense ratio to the performance of funds. Why does SEBI want to do this? And what are your views on this change?
Right. So SEBI, again, backed by data, has shown that the outperformance of mutual funds in general over benchmarks. It has given the data for all active mutual funds, including equity and debt, and has shown that the outperformance of mutual funds over benchmark is quite low. It has shown this over 1 year, 3 year, 5 years, and 10 years. For example, it has given data where it says the percentage of funds underperforming, the benchmark for over 3 years is in under the regular plan is as high as 67%, right? So only about 1/3 of the funds actually outperformed. Under the direct plan, this number was at the percentage of funds underperforming was about 52%. So two data was brought out here. One, mutual funds are struggling to outperform their category. Even assuming it's hard for debt, not category, sorry, the benchmark. Even assuming that it's hard for debt funds to, outperform their very theoretical benchmarks that they tend to have, even giving leeway for that, even equity, as we know, funds have been struggling to outperform their benchmark. And if this is the case, the proportion of the underperformance is so stark in regular compared with direct. In other words, just to give you one example, a percentage of funds underperforming over 10 years is 60% under the regular plan and 34% under the direct plan. This is according to Sebi's data. When I say underperformance, Sebi has given various breakups: outperformance by 1.25%, outperformance by 0.1 to 1.25, and then underperformance. I'm only talking of the underperformance. So about 1/3 of funds under direct plan underperformed over 10 years, and 60% of funds underperformed under regular plan over 10 years. So this, is very, very stark data where SEBI realizes its funds are finding it so difficult to outperform. And this difference primarily is significant in regular. Then let me, base everything on performance itself. So if you perform, the fund gets to charge more. If you underperform, the fund gets to charge only as much as, a passive product. So that's the genesis behind, suggesting this.
And SEBI has also talked about distributors switching customers from low TER to higher TER funds. How does it propose to curb this practice?
Yeah. So SEBI here again looked at data and it, found that in many cases, especially in case of NFOs, distributors were switching money from regular, ongoing schemes to NFOs. And in NFOs of active schemes, 27% or well over 1/4 of the inflows was coming from such switches. Right. So this was, a significant amount that basically is being switched. SEBI also made note that over 90% of general switches, happen, by this way of just switching funds, between, one to the other. So what SEBI is trying to do now is that to discourage such kind of churning from a lower TER scheme, typically the money moves to a higher TER scheme. That is a scheme with higher expense ratio. So to curb that, it says that the previous commission structure will continue if the previous fund was a lower TER fund. In other words, if you move from a lower TER fund to a higher TER fund, only the lower TER will prevail. In case you move from a higher TER fund to a lower TER fund, the lower TER will prevail. In other words, the lowest of the two schemes the lowest cost of the two schemes will only be, be the commission that would really go to the distributor. So a distributor will not benefit from switching schemes. So this is important for an investor because this will significantly reduce the cost, even if they are, unknowingly missold products, even if they have sold a higher cost product, end of the day, the commission that goes to the distributor is going to be lower. And the only difference, in most of these cases is the distribution, commission. That is why the expense ratio is also typically high. So this is what it has tried to do through this proposal. This proposal, if implemented, will really reduce churning in the industry, especially, taking money from ongoing, funds to NFOs, etc.
As things stand today, before the consultation, the proposals in the consultation paper get implemented, how much weight should customers give to expense ratio when selecting a fund? and how much weight should they give to performance?
Right. So, more than weight, I would say the order of looking at any scheme should be performance and then expense ratio, right? Because if a fund is a non-performer, it does not matter that it has a lower expense ratio if it's still going to underperform benchmark and peers in spite of lower expense ratio. So the first thing would be to look at of course, your suitability about the fund, the category, etc., and the performance. Once the performance is seen, you could then go and check how it compares with its peers, but that is of less importance because once there is performance, it's going to outperform peers even with a higher expense ratio. So the second thing and the more important thing that you would look at is what is the differential between itself and a direct plan, right? If this differential is very high compared with the broad differential of other peers, there are tools to look at this. Then you can conclude that this plan is good, but this plan is very expensive under the regular plan, and therefore I'll go for the direct plan. So that should be your approach to choosing funds. Look at expense ratio, not in absolute terms. Look at expense ratio in comparison to peers after you look at performance, and look at expense ratio in comparison to the direct plan of the scheme. And when this divergence is quite high compared with the category, for example, if the typical regular and direct plan difference in a certain category, say flexi cap is say 1.2%, and a certain fund that you have chosen has a differential of say 1.5%, it is far higher than the category average. That means you're better off with a direct plan in this particular category. Even if the fund has been chosen by your own filters, or if somebody had suggested the fund, you have every right to go to a direct plan instead. You don't have to compromise on a fund if its performance is good by not going for it simply because its regular plan expense ratio is quite high. But if you think the direct plan expense ratio itself is quite high and the performance is not great, then there is not much of a point in holding it.
And in which categories should one be especially careful about the expense ratio?
So investors, two things. One, in debt, forget liquid and so on. The liquid money market won't be much differential, but beyond that, short duration, medium duration corporate bond in debt, because your returns itself are in single digits, the expense ratio can impact your returns even if it's by a small few basis points. So expense ratio becomes very important in debt. The other category where expense ratio is charged highly is the hybrid category, right? Your balanced advantage, your multi-asset allocation, your equity savings. That's somewhere that you should be conscious of and look at expense ratio before you choose the fund. And the one more point in overall, sometimes there are newer fund houses coming up. They are smaller. Their expense ratio will seem high naturally because they incur higher costs. Their AUM is small. Their cost is spread over a smaller AUM. They incur more distribution costs. So they tend to have higher expense ratio. In those cases, please see if performance is good. Like I said initially, if performance is good, there is no reason to completely reject a fund because its expense ratio is high. A 5,000 crore fund, having a high expense ratio should not shock you compared with a 25,000 crore fund that has a low expense ratio. Ultimately, the performance will matter.
Yeah, Sebi has also provided data on outperformance, as you said, of regular funds versus direct plans. And there is also this thing of churning by distributors in regular plans. In the light of both these points, what would your advice to customers be about choosing a direct versus regular plan?
Right. So the thing is, we cannot outright, write off regular plans, because when you choose regular plan, you choose it because you don't have time to do your own research, nor do you have channels who do that for a fee, or you haven't chosen one. So if you have a good distributor whom you have dealt with for long, and he or she has, you have evidence of he or she delivering for you in the past, just it is enough that you keep an eye on the expense ratio and demand a comparison of the expense ratio of the scheme that they have selected. Simply check whether it is lower than the category average. You don't have to compare it with the lowest cost scheme. Just compare it with the category average. So that's one thing that you can do if you're a regular plan. But if you want to really reap the benefits of lower cost, right? Because the differential is so high, as we can see, then the only way to do it is to go direct. So either you do your own direct, DIY as we call it, or you pay a fee to, a fee-based advisor. If you have especially a large AUM, then the fee does make sense. But if you're just building your own corpus, etc., it's easier to do some amount of research to choose simple funds. You don't have to get too complex. If you are doing your own investment research, stick predominantly to index funds with just a few sprinkling of active funds here and there, and you should still do good, because we know that funds are struggling to beat indices. So there's a very high chance that by staying with index funds, you will actually be doing well. So that can be your approach if you want to really benefit from the cost savings coming from going direct.
Thank you, ma'am. Thank you for explaining the nuances of the Sebi consultation paper. I'm sure our viewers will gain immensely from this interaction. Thanks again and have a nice day.
Thank you, Sanjay. Singh.